never talked to me.
Oh, cool.
Instead of asking hard questions.
Did he? Didn't throw any questions. Cool. All right. Well, welcome everyone. We're because I know this is before work for some folks. We're gonna get started soon. Maybe we can. Cool, awesome. All right, there's a little morning club atmosphere. It was like Daybreaker there for a moment. Welcome. This is our new to VC series. So now that you signed up for this one, you'll get invites to future ones. Basically, the reason why I started this was because getting into venture, or even just if you're already in and starting out, is not exactly the clearest path in the world. And those of us that have been in it for a little while went into it at a time that was very different than now. So we're just trying to bring transparency to the asset class and to career paths and all of that sort of stuff. I was just going to share some thoughts and give a talk, and somebody was like, so it's just going to be you sitting up there just spouting? And I was like, oh yeah, now that you kind of put it that way, I said, I think maybe it would be better and more well organized if I had a moderator interview. So I'll let you introduce yourself, but he's sort of in the same path as probably many of you guys, so I thought he'd probably be a lot better at figuring out what everybody wanted to know. So.
Yeah, well, hi everyone, my name is Lawe. I spent some time at JP Morgan across corporate finance, investment research, spent a short stint at a credit fund in a product specialist seat, and rejoined JP Morgan as vice president to focus on their venture banking group. I'm taking a short sabbatical, but just focus on just transitioning within the venture capital space and mentoring startup companies.
And also I want to thank Republic for hosting us. And Republic is a crowd investing platform. Before you ask the question, it's something that comes up every time I talk about fundraising. Hey, I've heard all sorts of stuff about whether you should go to crowd investing platforms and all that sort of stuff. I have invested in deals that have done crowd raises. At the end of the day, I'm a big believer that if you have a company that investors want to invest in, they don't really spend too much time thinking about what the cap table looks like. They just want to make money. And, you know, in my eyes, you know, if you have a good enough story and a good enough network to appeal to dozens or, you know, 100 people on a platform like that, it's in some ways maybe more impressive than convincing one VC that is mistake prone to invest in your company. So I'm happy to back companies that are on any of these crowd raising platforms. So thank you for hosting. Cool.
But yeah, I have just a list of questions written here. But I guess just to begin, could you give like?
So you're gonna go easy on me, like?
Yeah. Yeah. Just to begin, if you could just give the audience just a thumbnail sketch of just your upbringing growing up in Brooklyn.
Yeah, sure. Okay. So first of all, as some of you may know, I recently announced that I'm going to stop investing out of my funds. I'm not raising a new fund. In the process of closing our last deal, which should happen pretty soon. And growing up, I did not know anything about that venture capital existed or anything like that. But I did grow up in New York, out in Brooklyn and Bensonhurst, and Wall Street kind of loomed large, right? So from my purview, like smart people who hustled, there's a big age gap between me and my older brothers. One of them's 16 years older than me, one of them's 18 years older than me, same parents. So they both worked on the street. So I was like peripherally aware of the stock market. My godfather had given me a few shares of IBM when I was born. So like as a little kid, and it's kind of funny how media and all that has changed. Like, you'd watch the news and they would say like, IBM went up today, GM went down today, and there'd be like 5 stocks they talk about all the time. So it was kind of neat that I was like, oh, that my little stock was one of them, and I knew it was better when it went up and not as good when it went down, and that's about all I knew. So I had an inkling that like business might be a thing that I was interested in, but I didn't really know what that world was like. And I think it's true that so many times people ask you like, well, what do you want to do? And you don't have really good insight into like what there is to do. So it's not enough when you're in college to say like, oh, I want to be a finance major, because the number of things you do with a finance major is like really wide. And a trading job is dramatically different than being an investment banker, and that's dramatically different from being, a VC. I remember interviewing an intern when I was at the General Motors pension fund, and I asked him where else he was interviewing, and he said a trading room. And I was like, we are a buy-side partnership investor in private equity. The pace is so much slower than being in a trading room. It's like not even close to being the same job. You're going to be bored as hell here. If a trading room environment is what you want, like this is not it. But I really got some insight into like what this world was like, because I got an internship in my senior year of high school. My high school had this internship program where after you made your after you applied to your colleges, they basically kicked you out, because like at that point you just had to pass and you kind of goofed off and messed up everybody else's education. So they're like, get out of here. And I did this internship at the General Motors pension fund, and that was after a couple of summers like working in a mailroom on Wall Street. And so like commuting into the city and going there was cool, but I didn't really know what was going on. That was a good environment for me, because the buy side is very thoughtful about the investments they make, because they have to own the investments, right? It's a little different than the sell side, which is more like brokering the transaction, getting the deal done, and if the deal works out, like that's gravy for the client, but they don't. That's not the way they get paid. They get paid on a transactional basis. Whereas like we got to see things that were, that we held for a long time, and got to, had to deal with our performance, so we could be like that much more thoughtful and maybe a little academic about it. So that was really interesting.
Got it. And from your process, I know that you were a solo GP at Brooklyn Bridge Ventures. How was your process raising Fund 1 and just building connectivity and getting buy-in from LPs?
It was so bad. I really had no idea what I was doing. I was not particularly well positioned to raise a fund. One of my biggest career regrets, actually, was not building better relationships with capital. So when I was at the General Motors pension fund, we were investors in a lot of big-time private equity funds, the Blackstones and Apollos and all these other things. And I met a bunch of those partners, and some of those partners were just not my type of person, but some of them were like perfectly nice, interesting people. But I had a really short-term view on networking. I was like, oh, I don't want to do your job, so why would I continue a connection with you? It never occurred to me that there might be other reasons, especially in the private equity world, where like they own companies large enough that my companies now could be selling into, right? But it never really occurred to me. I was like, oh, I don't want to be a buyout person, so I'll just stick to sort of networking with the venture folks. 20 years later, some of these folks are on the cap tables of deals that I do as angel investors, right? They're managing $10 billion private equity funds, and they're so super excited about the 25K angel investment they just made in some app, and they're spending a disproportionate amount of time with that founder because they think it's cool, right? So I didn't realize that in the future I could have interestingness that they were would find compelling. So I didn't really maintain those connections. And so I went to go work at Union Square Ventures. They had actually pitched to GM to raise their fund. I pounded the table for us to say yes. We didn't. We thought the fund was too small. It was only 2 partners. It seemed like kind of a rinky-dink shop for like, a big-time pension fund. That first fund is probably like a 20x returning fund, so that would have been a really meaningful outcome. And then I went to go work at First Round, but like nowhere along the line did I have connections to people who would invest in the type of fund that I raised. Right? Sometimes, occasionally, VC funds, bigger funds will invest in smaller ones, but I didn't really work for huge funds, right? Union Square Ventures, the first fund I was at was a $125 million fund. First Round Capital was like $130 million funds. So these are not, significantly sized funds that have lots of capital to go invest in smaller funds. And then the relationships I made while I was at the General Motors Pension Fund on the fund investing side were like the New York State Teachers Pension Fund and LaSera, LA County, and Texas, like people that wrote $25 million checks. Well, I raised an $8 million fund, a $15 million fund, and another $15 million fund. So they weren't the least bit relevant. So I literally started from scratch. I had connections to 2 kind of whales when I first started. There was a high net worth individual that seemed really interested in putting $1 million into my first fund. We went back and forth, and he was like, well, I don't want to be the only million in the fund. I was like, well, yeah, but then you come in, people will come in after, it'll start the momentum, and it was just sort of like, can we close now? Who else is closing? Well, you're closing, like back and forth, and that ultimately didn't wind up working out, despite I was willing to give that person special economics, and the whole thing kind of blew up. But I overspent time with that one person. And then there was more of an institutional investor that was trying to get into the space, and they came out of the Cranes article about the launch of my firm. Cold email, hey, read about you in Cranes, which, by the way, people raising money in New York, like, people with money read Cranes. Like, a lot of people in the venture world don't really think about it, but it's like sort of still an important publication to a lot of folks. And they were asking me questions like, well, what would it look like if we were a majority of the fund? Wow, these guys are serious. They're going to put $7 or $8 million into this thing, right? And I'm thinking, we seem to be towards the end of our questioning, right? So I'm going to have like $8 million within a month. It's going around. At some point, I was just like, hey, so how do we close? And the guy whose point was like, well, we have to hire a head of fund investments. And then once we hire that guy, then we're going to create a strategy. And, oh, you don't even have the person who can make a decision on this yet. So we're talking like a 5 or 6 month thing. And he's like, yeah, September sounds good. I was like, okay. And exactly how much money are you considering? It was like probably like $1 million, $2 million. Great. Awesome. I will pencil you in for, $1 million or $2 million in September, but like here I am in June, and I have basically wasted 5 months on this race because I have overspent time with 2 people and I have nothing to show for it whatsoever. And it was at that point that I realized, like, oh, this is a sales process. And if I were invested in a company and I was talking about their sales process, if they spent all the time talking about 2 big clients anecdotally the whole time with no metrics and no asking them what's the close process and what's their budget, like this would be a really bad sales process. So I immediately started like filling the funnel, and I talked to everybody. If you met me from June of 2012 to at any point in the next 13 months after, I would drop the term family office to see if your eyes lit up, because I wanted to, I don't know who like I would randomly answer questions to like, I ran into this guy, Brian Shields, who's now on the West Coast. And Brian was like, hey, how's it going? I was like, oh, doing the whole fundraising thing, talking to family offices. See if like, and then he randomly was like, oh, I know a guy who works at a family office. It's like, really? This has never worked before. And he introduced me to Brian, I'm going to totally botch his last name, formerly of KEC, now of Refashioned, If you've
Yeah.
met him, like, he's literally the nicest person in venture capital, and he's super smart and he's super well read. And Brian worked for a family office at the time, and that was the intro that got made, and that family office wound up investing in my fund. And I wound up pulling in some high net worth people for a first close. Eventually, that institution wound up coming in, so I packaged them together with a couple of other folks. And I had I think it was like a $3 million first close in the end of September. I had started to meet with companies, and I was very upfront about the fact that I had not closed yet.
Yeah.
I think that's really important because all you really have is your reputation. Like you are just capital, right? You're a check. And if I've had the experience, one of my portfolio companies was talking to a fund that was trying to close their second fund. And yeah, we're going to close in September, and then September dragged into October, and then November or whatever. And that fund never came through. And I'm never going to send another deal to them, even if they do close. They just weren't really upfront about whether they had money or not. So, it was not an easy process. At one point, I literally downloaded every single contact I had. LinkedIn used to let you download all the emails of all the people you're connected to. Now they don't, so you have to grab all these little plug-in programs like Wizza or whatever. And I BCC'd everyone. And the note that I wrote was I'm about to do a first close on this fund, but I didn't make an ask right away. And I never would have thought so strategically about this email, except that this woman who worked at a publishing company, a tech sort of publishing company, responded back to the email with the breakdown of my own email that she then sent to her staff about why she thought the email was good. So this is not me saying it, this is somebody else's analysis. I didn't make the ask right away. The first two things I had in the email were hey, I'm about to close. So if you have companies, send me deal flow. I'm gonna have money. So here's the kind of companies I want to make an investment in. These companies are going to spend this money on talent for the most part. So if you know people who want to work at startup companies, I'm going to be investing in companies that are in a position to hire. So again, another offer, right? I have money. This money is going to be hiring. So send me people, right? And then lastly, the types of people who are investing in the fund are investing in for the following reasons. One, we were opening up to co-investment. So if you wanted to come in side by side, we were doing that free and clear of any carry or fees or any special structures. And that opened up the fund to folks who would otherwise consider themselves angel investors and wouldn't have done a fund. Maybe they were part-time and didn't feel fully in the market. And so this was interesting to them because they're oh, so if I put a little money in the fund, I'm going to see all 30 of your deals in this fund. And then also when I see a deal, I could send it your way and kind of treat you like a free analyst. So because if I had a family office and I had hired somebody, well, that's 100, 150 grand out the door, regardless of whether we make any investments, regardless of whether any of them are successful. So I get the benefit of having your experience and expertise. And ideally, some of that money is going to come back. I mean, you're not going to lose it all, even if you're bad. Sometimes a bad fund is 50 cents on the dollar. Yeah. So I got in a couple people that way who wouldn't have otherwise considered themselves to be fund investors, but they were just angels who wanted the deal flow. We packaged that up. Absolutely no one that I BC'd was pissed off or, just a lot of people didn't respond, but most of the people are oh, good luck. I was well, great, whatever. But I did wind up sourcing another $1 million from that email, and it came from the most random source. It was a guy who was an intern at a first-round capital portfolio company that I had given some career advice to because he was the cheapest guy at the company. He was the last man standing when it went out of business. And he was what do I do next? And I think maybe I spent 25 minutes on the phone with him. It wasn't a lot, but he really appreciated it. It turned out his brother and his sister-in-law had bootstrapped and sold 2 companies, one for like $8 million, another for 30. And when you own 100% of a company that you sell for 30, like you're in a position to make fund investments. And they realized that they were not particularly well connected to the New York venture capital community. And my whole pitch was about being connected to the community. So they were like, yeah, maybe we should do some angel investing or whatever. So when he saw the note, it was like, this might be an on-ramp into the community. He forwarded it to them and made that connection. Then I got a couple of other random people sort of from that email. So, and nobody that I've ever would have pitched. So those were contacts that were just generated by the blind CC. So it took me, I think, 14 or 15 months to get the first close was 3, and I think there was a close of like 2, and then there was like 3 and change sort of towards the end after I had some deals. I had a couple of markups from Series A's towards the end, and a couple people came in thinking like, oh, we're getting a deal on these companies. And like neither one of those companies wound up panning out, and the other companies in the portfolio turned out to be the better deals. But I don't know, I felt good about it. At least that the fund was directionally moving in a good spot. So yeah, but it was a slog. That original fund has 70 LPs, all sourced completely individually. So you can just imagine how many meetings 70 investors took.
That's incredible.
It was a lot.
Yeah, and I was also curious just the evolution of just like your investment thesis or strategy over time, like how your first investment has differed from like the last investment that you've made.
There actually hasn't been a lot of changes over time. I think there were a few changes from like what I was doing in my 2 previous funds. You know, Union Square Ventures was basically a Series A shop, although the first deal that I was invested in, that I was involved in when we were there, was actually a company called Delicious, a sort of bookmarking tool that sold to Yahoo. And at the time, we didn't have very many portfolio companies. There wasn't really a thing in 2005 or 6. There wasn't really a thing called, you know, pre-seed investing and all of that. There was sort of angel and then, you know, sort of institutional. But we sort of figured like we had the time to spend with this company. They didn't need a lot of money, so this was kind of a little bit of a different bet. And that was fun. I mean, it was like Josh Schachter took a 1-room office in our building downstairs from us, and I saw that company literally from, you know, the first computer they bought on a folding table and, you know, a beach chair that they put in their office. Like that, to me, was like, oh, this is cool. This is much more interesting than, you know, coming into a company that already had 20 people or what have you, because you could really make a difference in this kind of company at that stage. So that was interesting. I also, just from Union Square to first round, like I like the pace better. You know, when you're at a Series A firm, at best, you're doing a deal or 2 a year. And these days now, you're probably lucky if you're going to do a deal this year. Whereas first round, each of the partners were probably doing like 4 or 5 a year. And so it just sort of felt like anything that you saw had a decent chance of getting pulled over the line. So I was there 2 years, and I did 9 deals out of the 12 that I sent to the partner meeting. And it was just, at that stage in my career, it was fun to do deals. I wanted to do more of them. So at Brooklyn Bridge Ventures, I did kind of 9 or 10 deals a year over the course of the last sort of 10 or 11 years. You can focus on geography, you can focus on stage, you can focus on a sector, but the moment you start combining all 3, the pool is too small, right? So you could do early and New York, but you can't really do early and New York and enterprise, because then you're really narrowing down a bit too much, I think. So I just chose to go early in New York. It was also a function of like, I am not necessarily a domain expert. I don't have the attention span to focus the way some people do. And so, I'm not a sort of details oriented kind of person. So it was just fitting that, I would look at a consumer deal and then look at an enterprise deal and then something in food and then something completely different. It was just much more fitting of my personality. The market kind of changed a little bit, right? So while I was doing this fund, the sort of concept of pre-seed got invented, although I would argue that all the rounds kind of took one step to the right, because if I look at my original fund model, and I would highly encourage anybody who's raising a fund to do this model of how much do I put in what size round, and what is the price, and then how many of those deals make it to the next round, and what does the next round look like, what's my dilution, and do I follow on or not, or whatever. What's my average outcome, how many of those outcomes do I get, to literally put together, like, what's the IRR on this? And the original deal that I put together was like $1 million round, probably on a post of like 5.5. And then the next round after that would be like 5 on 20. Those deals now probably haven't changed that much since then. I mean, maybe the next round is this sort of like 3 on 15 or something along those lines. But at that time, that $1 million round on 5, 5.5, 6 was a seed round. And now it's sort of a pre-seed round. It's kind of the same round. Companies at the same stage, but they call it different stuff. But it's that earliest sort of first institutional check that I've kind of tried to focus on. So all of the deals that I've done have had less than $750K raised prior to me coming in. Or even if they raised a little more, they just haven't spent it and it's still sitting in the company.
And I guess for your fund, like a target ownership you like to see is roughly like 20.
I don't even think about ownership. I never make the calculation. I couldn't tell you what I owned in any of these companies. Like, you can't eat ownership for breakfast. You eat dollars, and it's dollars in, dollars out. What people should be much more concerned about is multiple, because, like, literally, if I had enough capital, like, I could buy 20% of Stripe, but that doesn't mean I'm going to get a venture return on it. So you really want to care about, like, what's your going in price and what's your exit price. And if you're an equity investor, you want to buy low and sell high. The thing I cared much more about was my going in price, because I felt like it was very hard to be able to tell, was this deal going to be the big one versus this other deal, which could get a medium exit? Like, you'll never be able to predict that stuff. So you have to assume that, like, each of these things is going to be kind of whatever your average win you consider to be. So if you can't control for that, you can only control for your going in price, and how much you put in at that price. So actually, if you want to maximize your outcome with portfolio construction, the only way to do it is by doing equal weighted bets where as much money as possible goes into the cheapest round. That's it. Because if I basically told you, you have a fund and like half of the deals go out of business, 3 of the deals become winners, but you don't know which one.
Right.
If you want to optimize the outcome, you say, okay, those 3 deals, I'm going to equal weight because I don't know which ones, right? And I'm going to front load in the cheapest round, right? Because if I can't predict which ones are going to be the winners, then what's the sense of sort of paying up in the next round, paying up in the next round? Now there is a value to like the signaling of participating in future rounds. I don't necessarily think it means you have to do your full pro rata in most of the deals I've done. As soon as the entrepreneur is like, yeah, everyone's participating, like, no, the bigger funds, they don't care. Some of the ones, like when I did my first fund, I didn't do any follow-ons, or hardly any. And sometimes it'd be a question like, oh, why aren't you following on? It's like, well, my fund's $8 million, yours is 200, so like that's why I'm not following on. They're like, oh, okay, that makes sense. You don't have any money to follow on. Awesome, great. We just wanted to make sure it's not a qualitative thing on behalf of the portfolio company. I was like, no, I put in $300K into this company in a $8 million fund. So like you do the math, as a percentage of my fund, I'm putting in more than you're putting in this round. And that was the end of the conversation. It never really mattered. So I'll do like token follow-ons just in the next round. But for the most part, I'm like front loading as much as possible. Now that's different if you're raising a $100 million fund, because in a $100 million fund, you can't front load as much because the round's too small. So the nature, the fact that the assets under management, you have to follow on because the money's got to go somewhere. The initial rounds are too small. And your big winners, you'll still get a great return, but you're never going to get as good a multiple as your first check because that's always going to be the cheapest.
Yeah. And I was looking at an article that was written like 2014 when you did launch Brooklyn Bridge Ventures, and Fred Wilson also like wrote like an article about that process too. But you mentioned like economics was like 2.5 and 20. I was just wondering, has that process like evolved over time?
Yeah, I make less now. I don't know if that's a good decision or not. But ultimately, and this is also a reason why you should like really do this fund model, is you see how much it outputs, right? And you talk about raising a small fund, and you do the math, and you're living in New York, and there's just a reality to like, this is how much the fund makes, and like you make carry, and you ask the question of like, oh, well, how long reasonably does it take to get an exit? And if the answer is 8 years, then that's 8 years from deal one, right? If you're putting the deals to work over 3 years, then it's like 8 years from year 3. Now you're 11 in. That's a lot of rent to pay in New York before you start getting those carry checks, if you get them, right? So there's a reality to like, how much management fee you can take. And oh, by the way, that management fee has to be paid back, right? So the way it works is that your management fees are essentially borrowed from your investors, and you don't take a cut of the carry until they get paid back all the money that you took out of the fund, right? So yeah, you could up your management fees if you have a small fund, but that money's got to be paid back. And the only way you can pay back is through the investments in the companies, right? So any money that you don't put into companies, you're just lighting on fire, basically. There's a reality to like how much you need to take in salary and all that sort of stuff. So when I raised the $15 million fund, I actually lowered the management fee from 2.5 to 2, because ultimately, like, I'm trying to be in it for the carry, and because otherwise, as just a job, I can make more money elsewhere. So I was trying to put as much work as possible, as much money to work as possible in the companies, which sort of bet on myself. I was also like living in Bay Ridge and not paying West Village rent, and making certain commute sacrifices, and single, and all that sort of stuff. So yeah, nothing much has changed about those economics. Sometimes people try and mess with the economics. Well, if I get this outside return, maybe I can collect 30, or like. In my experience, the more complicated you make the fund, at least for like individual investors or family offices, the more they feel like they're going to get the short end of that stick. And I just think like, I am the type of person where I appreciate simplicity, which is also why I never did SPVs or side vehicles or 8 different ways of getting paid or whatever. Like for me, I just didn't want to have to deal with potential conflict, or like if you were my portfolio company and you were trying to figure out if you were like the hot portfolio company that could take anyone they wanted in the next round, and I was like, well, listen, like I have this vehicle and other people want to do it. Well, yeah, but I'm getting paid out of this vehicle, right? So is it right for you to take money from my vehicle that I'm getting fees off of, or for you to take a bigger check from Excel? Like, I didn't want to have to deal with that conflict.
Yeah.
Maybe it was short-sighted for me to leave money on the table, but I'm just much more into like transactional simplicity. That's personal preference.
And last question for me before I open it up to the audience. I guess, what was the time in your career that you felt like the most alive or got the most fulfillment?
That's a good question. I think you have to be interested in it every day. I think like somebody gave me this relationship advice that I think sort of matters. Um, your default shouldn't be that you're in it. Your default is that you're not in it. You have to choose to be in it every day, right? Now, relationships have up and downs, and I think like there are some days where you're just like, well, I'm in it, and I guess it'd be a lot of work to be out of it, so you stick with it for a little bit. But I do think you have to have that approach, and when it stops becoming interesting, then you shouldn't do it anymore, which is sort of partly why I stopped, is because a lot of people were sort of scratching their head about like, it's so hard to get into venture. You're in the middle of it. You have some momentum, some good portfolio companies. Like, we're sort of really perplexed and figured, well, there had to be some other reason. And it's like, no, like it's not like it's not like it's 0% interesting, right? But it just wasn't as fulfilling as it was before. And I think as a percentage, like, I would say every day there would be something where I'd look back and be like, oh, that was pretty awesome, right? But then also there'd be something else that was kind of a drag, right? So you take, like yesterday, like I had a portfolio company update where I knew somebody was raising, and it's a founder that is really doing like a terrific job. They've done a terrific job from the start. But they've also grown and gotten a lot better organized as a manager as they've gone on. And it's really been very fulfilling to see their growth as a CEO. The company's working, like it's really working, which is great. They're like basically cash flow positive now, very early on. They got inbound to take a little bit more money, not a ton, but just it's really gonna throw some gas on the fire of this growth. And he, in a very difficult environment, has sourced some more capital for this, and it's like everything about the company is going up and to the right. It's just awesome. And the check-in was like very short.
Yeah.
Right? It was like 20 minutes. I was like, hey, so like I made some capital intros. Like, what are we doing now? Just checking in. Like, I didn't want to let these go too long. I was like, oh well, looks like we're going to take money from these guys. I pushed back on terms. They seem to have agreed. Like, we're moving forward. And oh, how'd this other thing go? Yeah, it's going great, but awesome. I was like, wow, it's really fun. Like, this deal, everything that I hoped was going to happen is happening even better than expected. They're not all like that. Like, they're definitely not all like that. And there are other ones where you're in and the company's definitely going sideways and you're just like, I can't believe we're still at this point, right? Where you're just like, my feedback's the same as it was 3 meetings ago. And I don't look forward to the next meeting because I think we're just going to be in the same spot and it's super frustrating. I think you wind up in like, 3 buckets of companies, right? The ones that don't work out, which by the way, actually is some of the best relationships I have with portfolio companies, especially the ones that don't work out like kind of quickly, right? Because you try a thing, you work really hard, they make all the moves that everybody agrees, like this seems like the right move, and it just doesn't work. Some turns out to be harder. We had one company that the founder is back at it again. I'm glad because it's like an absolutely terrific guy. We had a co-investor partner that just sucked, and just we depended on them for a lot of aspects of our platform. They just like did not come through, and they really hamstrung us, and it was just a pretty awful experience, to be honest. It was really frustrating on behalf of the founder, and you bond in those like really difficult times, and the founder really felt like, he had failed and was upset about it. And I was like, dude, we're all adults here. Like, we knew the risk going in. Like, it's unfortunate that we partner up with these folks, but they said all the right things and they didn't come through. Like, I don't know how we would have diligenced that, right? So, and I'm super glad. I just texted him the other day. I was like, I'm so glad you're starting another company. Like, that'll be a career connection that I'll have for a long time. The ones that really, really work out, like this company now, I'm kind of glad he didn't raise big money because then I get to stay engaged. If you would have raised a big check, somebody else would take the board seat and, I get the board decks every quarter. And that's not as fun. Mm-hmm. Like Ben from Hungry Root sends me the board deck every quarter, even though I'm not on the board anymore. And it's like, great, thumbs up. You have a huge company now. And every now and then I chat with them. You don't feel the joy because you're not in that meeting every time. I'm not at the company. And, if we, knock on wood, ever get to ring the bell, that'll be awesome. And then, maybe I'll get to, experience that. But the day-to-day of the ones that work out, and actually that's probably one of the biggest issues, right? Is that the day-to-day of the ones that work out when you're a seed investor is really, the joy is short-lived. Right? Because when they get the bigger checks and you're not on the board anymore and you're not following on, you don't get to experience it as much. And so you spend your time with the companies that shut down and the companies that go sideways. As a percentage of your week, I was like, oh, I have 6 portfolio company meetings this week, and one of them is an up and to the right one. I have lots of up and to the right in the portfolio, but I don't meet with those companies anymore. And that's one of the things that sort of dragged down a little bit.
And then for the
question in the back.
Yeah, thank you so much for sharing, Charlie. My question to you is, I know there are certain opinions about investing in YC and Techstars alumni, but what do you think? Is it a wise decision given that you have to invest in the lower valuation?
So, accelerator alumni in general. First of all, not every accelerator is the same, right? So, somebody is launching something from
the drone.
Yeah, it sounds like a drone, right? Okay, so it's hard to make a blanket statement about companies from accelerators. Now, the one blanket statement you can make from an accelerator is at YC is that none of the companies are cheap, right? And so, to go back to if this is your check, right, you're definitely paying a premium. And yes, Y Combinator has shown historically to, at the high end, have a disproportionate number of really, really big outcomes, right? That being said, other than that 1% of their companies, does the average YC company, or sort of the median YC company, right? Because the average is skewed by those top guys. Does the median return on a YC company, given the fact that you're paying a 15 pre or whatever it is now, return? I don't know, probably not. So I think you gotta really ask yourself a question of if I'm paying up, is this the deal out of this batch? And I think there's a little bit of a skepticism, if I'm just your average angel investor, if I'm an East Coast fund without, top tier connections, why am I getting this deal, right? Because everybody is all over all of those companies, so it's kind of one of the reasons why I, for the most part, didn't do West Coast deals. It's because I mean, look, I like New York and I like New Yorkers, but that's not the reason. There's a reality to on the forced ranked competition chart in San Francisco, you have to be honest. Am I one of the, if I opened up San Francisco, would I be one of the top 10 places to go to for a chat? No, definitely not, right? There are other people who have launched company X or got public or done whatever, or, the first rounds of the world or whatever. In that ecosystem, which is a very efficient ecosystem where the entrepreneurs are very knowledgeable about who they can get checks from and where to go and whose reputation and all that. So it's like, well, if I'm not in that top 10 there, why am I seeing those deals? Now, not every great deal has pedigree and is known, but in that ecosystem, like kind of, because everybody has resumes, right? They're like, oh yeah, I was the lead engineer at Stripe and now I'm building this database thing. Well, yeah, you had top tier experience. You were, the second manager, engineering manager at Stripe, and you had 200 people reporting under you. Like, that's really top tier experience. New York resumes are kind of a little more all over the board. So they're tougher to evaluate, which means the top people are not as obvious on paper. So it's a less efficient ecosystem, so there's an opportunity if you're willing to kind of do the work. For the every other accelerator, I think it'd be an interesting little index fund to basically say, like, I'm going to try and do the top deal out of every other accelerator and just figure out what that time, and just blindly, ask every company in the class, if you couldn't invest in you, who would the top company be, and just blindly write a check to that company. Like, I'll bet you that's a pretty decent outcome. If you did enough deals and enough accelerators, like, yeah, I think you probably have a pretty decent outcome there. But I don't think there are other accelerators where it's automatic, right? Saying, oh, well, this is a Techstars deal or this is an ERA deal. But like the top company in the Techstars class and the top company in the, like, yeah, those are pretty decent deals. And I think if I were an analyst or associate, whatever, like, yeah, you should definitely be there at those demo days. And like, you should be there because you should try and figure out who the top 1 or 2 companies are. B, you should be there because all the other investors are going to be there, and that horse trading of just, market information. But I would also be careful about, like, you want to horse trade about industry information, not about company opinions, right? So, like, if you talk to, your peer analyst at another fund, and they're like, well, we really weren't sure about that team, right? Well, I don't know, you could be wrong. Or maybe your fund has a blind spot for first-time founders, and you're just not good at evaluating first-time founders. Like, I think it's really important to, kind of make your own decisions. I was led the seed round of Petal, the credit card company that, is doing terrifically well. And a couple of seed funds, the kinds who write like $1 million checks, like, passed, and I think there's like 23 investors in that seed round. I mean, it is a mess. And I think at 300K, I'm probably the largest check in that $3 million round. Like, there's a lot of people in the round, and everybody passed. Like, so, if you were just like, oh, I don't know, like, this fund passed and that fund passed, like, it'd be very easy to be like, oh, I guess there's something wrong with that company or whatever. They just missed it, or it's too early, or what have you. So I think you really got to be careful about, like, just basing it on other people's opinions.
There's definitely a perception right now that younger entrants and newer entrants in the VC space are kind of this hive-minded, opportunistic type of VC rather than, doing due diligence, really developing conviction in the area. How would you recommend young people who are entrants in VC go and, like, develop the skills in developing their own conviction?
It's a really interesting dichotomy you just put out there, because I wouldn't necessarily say those are the only 2 options, that you're either hive mind or you do a lot of due diligence homework. Because I think you can make independent decisions with less information. So, and in fact, actually, I think you're almost more likely to be hive mind the more information you have, because it's a generally efficient market for information, right? So the idea that you're going to learn more about the company and that it's going to enable you to make a different decision. At the stage that I'm in, I've generally found that like the more information that an investor asks for, the less likely they are to get to a yes. Because they just haven't done that much yet, frankly. So like more information is usually bad, right? It's like, tell me about each of your customers. Well, there's only 2 of them, right? Or, tell me the customer references, right? The more time you spend with the customer, like it's probably unlikely that the customer is like, this does everything it can for me. Like you're probably gonna, well, they installed it and it broke at first, and it's the whole thing's been sort of pinned bot or whatever. Like those are the reality of the stories you're probably going to get. You start doing references on the founder, right? And the founders that jump out on their own and decide to do something, they're probably not great employees, to be honest, right? So you're going to dig up something and they're like, well, they were a pain in the butt to work with or whatever, or they're and that doesn't, you want to make sure they're a good person, but you might not get the best feedback. I think I've found that you can do more diligence on a space that probably, to come up with a thesis on your own about the direction that things are going, than an individual company at this stage. And you want to have a prediction about like the way the world is going. And I think you just do that by talking to a wide variety of people. I think you want to look at a space from different angles. And that's one of the reasons why I actually like being in New York too, is because you don't only run into one type of person with one type of perspective, right? Like it's really important for you to talk to as many people as possible who are creeped out by talking to Alexa, right? Because if you don't expose yourself to people who feel that way, then you need to balance those people against the people who are like, AI is going to take over everything. It's like, no, some people aren't comfortable with that. And like, why aren't they comfortable with that? And when do they become comfortable with it? What types of things they want to see? What are the barriers, right? I had a conversation with somebody the other day about sort of a computer vision based dating app. And you just need to talk to a lot of different people about dating. And it just, you could dive down as deep as possible about the tech, but to have an understanding of like, when do consumers feel like something is creepy or not, and why is like, there's no replacement for that. And I think that's where you can, start to have better conviction about stuff. Me personally, I also feel like writing has been really, really important for me. If you don't like to write, just keep writing. Just practice at it. Everybody starts off being a horrifically bad writer. And I go back to the first few blog posts that I wrote. I've now been blogging for 19 years. They're terrible. They're really cringy. But I think it forces you to order your thinking. It's almost like when you think you have a really good idea, and you're like, oh, let me tell you about this really good idea. And I start telling you about it, like, oh, now that I say it, this doesn't make any sense at all. And it just forces you to get your ducks in a row on your thinking and to get feedback. So I would highly, highly encourage you to write about what you're interested in as much as possible. I never really paid that much attention to like what everybody else was writing and to try and put it in this particular format that's going to be like, oh, this Medium post about the top 10 use cases of AI. Like, if you don't want to write about AI, just don't write about AI. Just write about whatever you find interesting. And I think that the deals and the people that are also interested in it will follow. And you can write from a perspective that doesn't have to be authoritative. You can just be a public student, just like, hey, I've been thinking about this, and here's what I see, and like my level of authoritativeness changed over time. Like when I used to be at Union Square Ventures, like it was more like, here's what I heard Brad and Fred talking about, right? Like just recognizing the fact that like those guys have a lot more experience than I do, and my writing is very different now, being on the other end of my career than when it was, because I still very much felt like I was like in learning mode, and that's fine to be publicly in learning mode.
So I've been kind of giving advice from other VCs saying that
You shouldn't take it.
well, I was just curious on your opinion. So basically, it's like not to get into venture until you're either done operating or done building, or using your kind of early 20s to build and create and found companies or help startups, versus jumping into like VC right when you begin your career.
It's also what Fred Wilson says, and he never did it. And he said that he sort of wishes he had that experience, or wouldn't necessarily recommend going in the way he did. I don't necessarily think there's one way to get into venture, although I think that like somehow along the line you need to convince somebody with money to let you spend it. And so the question is like, what is the way that they are going to do that, and what is the resume that you're going in with? Right? And so I came in from the analyst route and then made the leap from LP over to venture, and got to see another firm, and was right place at right time in New York when First Round was looking for somebody to help open up their New York office. I mean, they were looking for network and deal flow, not decision making. And I had been at a VC, but like they just wanted me to bring in flow. And I was very plugged into New York because I was doing this sort of community thing, right? And I was very lucky. The two of the deals that I did, GroupMe and Single Platform, while I was at First Round, exited before I raised my fund. So I was like, here's my 9-deal track record. 2 of them have exits. So, I must be fishing in the right ponds. Statistically, that's not likely, right? Statistically, if you do get to do 9 deals, they're just going to be sitting like maybe marked up, but even then, after just 2 years, maybe not, and you're going to have this like mostly unrealized track record. You might even have a write down in that. So to basically say like, hey, I'm going to do a handful of deals and then go raise. Like some people do that as angel investors, right? Well, I'll go do a couple of deals, then I'll go raise. It takes so long for those deals to show that there's an outcome that like, I don't know what that's actually going to show. Maybe you get lucky. But being able to say, I was first at this company that grew, yeah, that is really impressive. And that gives you a couple of things. Like, it's impressive to somebody who's hiring at a venture fund. But also, the thing you really need to be reverse engineering is like, okay, so I'm not Josh Koppelman, or I'm not Kirsten Green, and I am a junior VC, and I need a company that's going to be the next big thing to meet with me, right? Because if I'm the analyst or I'm the associate, they're going to try and go around me, right? So like, why are they meeting with me? And if I wasn't the person who grew X, what experience do I have to offer them when it's very likely that they're the person who grew X, right? So if I was, the first salesperson at, Cockroach DB and really helped build their original enterprise sales team, then yeah, a lot of enterprise sales companies are going to want to talk to me, right? That's going to be really useful experience to bring to bear. Now, the difficult thing is like, look, it's hard enough picking, and I've been doing this for a while, right? So you get to pick one. What happens if you pick a company? And this is the sort of trade-off, right? People are like, well, I don't want to pick a company that's like 2 people in a PowerPoint because how do I know if that's going to be the one? The chances of that going to be the one are really low. Maybe I'll pick something that's a little more established. Right, but if you're employee number 50 at a company that just raised its B, your story's the same as employee number 51, 52, 53, you all have the same outcome, right? So that's probably not all comforting, but it is just like, yes, somebody out there is going to be the first salesperson at a company that goes public. And then everybody else is going to be the first salesperson. The company doesn't go anywhere. So if you do have the opportunity to work at something you do think is going to be a really great outcome, like, yeah, by all means take it, but you don't know. So what can you do in the meantime? I would say keep a really high bar for your coworkers, right? So regardless of the outcome, if you look around the table, the first 5 people at a company, and are they impressive? Like every last one of them. And if you're like, okay, maybe this company works, maybe not, but I'm going to be here for the next year or two, and all of these people are smart enough that I would back them. Chances are somebody else is going to back them, right? And you're going to build the beginnings of a really impressive network. Like maybe it's going to be the PayPal Mafia, maybe not. But I think you can certainly control for that. And I think there is something to be said for you march into a company that has a single-digit number of employees. If every single one of those employees doesn't impress you, what are the chances that they're going to get better over time, right? Because actually they have less equity to offer each successive person. So you really want to keep a high bar. Is it a problem you really enjoy working on, right? So, yeah, you're planning your career, but you still have to work there for the next 2 years, right? So is it that? And then, like, do you have enough degrees of freedom to make an impact, right? So, yeah, if you were the first enterprise salesperson and there's nobody above you and you've been tasked with sort of figuring it out and you feel like based on your prior experience of working at, Yext or whatever, doing, bigger customers, you feel like you can take enough from your prior experience, you have mentors from being at Yext or whatever that you can learn and really help this company, then yeah, if you actually have the running room to go build something, I think that's something you can control for as well. But, there are also other investors like Mike Moritz from Sequoia was a journalist. Like there are lots of people who do, lots of other things. I wouldn't say that there's a bad way to be in venture, although I would say what's going to differentiate you, right? Because if you're doing the analyst program at Southside Bank, like there are lots of other people who have the same exact experience as you, and it's just going to be really hard to stand out from the crowd, unless you're doing something in your sort of nights and weekends time. It's like, oh, I built a community of developers in AI or something along those lines. So 1 and 2.
So on like the venture capital industry as a whole, what is something you're most excited about, and then something you're kind of like nervous and unsure about in the next like 10 years?
Well, I'm not sure about anything for the next 10 years. I mean, I don't even know what I'm doing over the next couple of years. So, I think the thing that I'm probably most excited about is that the people who really are going to be successful in venture over the next 10 years are not a lot of the same people who have been successful over the last 10 years. And for a couple of reasons. One is, like myself, there are a lot of people getting out. I'm just doing it because I just want to do other stuff. There are some people who are getting out because they made a bunch of money and there's sort of a sea change in whether it's AI or other stuff, and they're just not up for doing this all over again, right? They've been a partner at whatever big firm for the last 15 years, made a bunch of money, and they recognize that like they're not a Gen Zer and 70 discords and they just don't have the time for that shit anymore, right? And so they're just like, you know what, I'll go like maybe do a couple of angel investments or hang out with my kids and do all that sort of stuff. And one of the other reasons why I'm excited is like, to be honest, just from a character and personality perspective, there's a lot of people in venture that I just wish weren't in venture. And, you know, I'm hopeful that there will be a new and better and more diverse crop of people. I can't even make it through an episode of All In. I'm sorry, but like it's just, you know, there's just that style of bro just needs to go. And I just really feel like I feel like the barriers to access to tech are just going down and down and down, right? Like it used to be that unless you were at MIT or Stanford, you were just not seeing the flow of technology, right? And then we had open source and cloud and all that sort of stuff. So technology came from more random places, and that's only growing, right? So there's just less of a stranglehold on, you know, new deals and founders and all that sort of stuff. So my hope is that who has access to the flow of good founders is also diversifying. So like, yeah, it's cool if you're at Sequoia, but like, how much of an advantage is that when like the next big thing could be invented by like students from the University of Wichita, right? And like, there's no Sequoia office in Wichita. Like there, you know, there's going to be other people doing interesting stuff coming from more diverse places. I do think there's a value to like being in cities and bouncing off of people, but you can start just about anywhere. So I think that's going to be cool. What was I most worried about? I'm not worried about the robots taking over. I think that's kind of overblown. And actually, I was sort of debating with somebody else yesterday. It's like, you know, all these jobs are going to be lost and all of that sort of stuff. Well, like, we have a ridiculously tight labor market right now. So actually, we have more work to be done than we have people to do it. So, you know, if we are going to become more productive, we actually do need some of the machines doing the work. Like it's hard to hire people to do certain things. And I think at some point, these things will just become tools that humans will, you know, control and implement and all sorts of stuff, right? Like the fact that you can make a website on Squarespace or Wix has not decreased the number of people who make websites, right? And that those platforms have been around for a long time. So I think ultimately people will sort of upskill into, you know, sort of higher level things. I think maybe one of the things that I'm worried about in general for the asset class is the hype cycle. I've never seen such a dichotomy between like what's hot and what's not, and how quickly, like, so I got into the Twitter book, like as being like early to discovering Twitter 9 months after it had launched, right? There's nothing out there where you can get any kind of cred for being 9 months late to the launch of a thing. Right, like that cycle has just shrunk dramatically, and now it's kind of like hot teams get funded with $10 million out of the gate. Like it's just things get anointed well before they have proven anything, and I don't think that's good for the ecosystem for a bunch of reasons. And one is like, okay, well, you know, that European AI company that just, I don't know, got $100 million or something, they haven't launched a product. None of those employees are going to make enough money to be angel investors because the value of their shares, now that this deal is already done, is so high that like, even if it does outcome for like a decent exit, they didn't get in low enough because the markup was so high starting out, right? You know, I don't think too much money is good for a company at that stage either. So, and oh, by the way, that $100 million that goes into that company doesn't go into how many other seed or pre-seed companies that can't get a check, right? So there's going to be innovations in other areas that aren't happening because there's one sector that's just like sucking up all the capital right now, and I do think that's a problem. I do think there's also a problem that like there's no like great minor leagues for both companies and investors. There's this gap. Like, I feel very fortunate to have raised the size funds that I did, but it's not easy. If you wanted to, just think about it from this perspective, like, you always want to have an ecosystem where it's not super difficult to raise a round of, call it $750K to $2 million, right? Okay, well, who's writing those checks now, right? Because it's really hard to keep raising $20 million funds because you can't get institutions into those funds because they write bigger checks, right? So you have to keep getting all these high net worth individuals or family offices and stuff like that. And the second the economy turns, those people pull out. Or they can't write 3 checks because it's just their own personal money. So the good funds get bigger, and then, you know, the first rounds of the world, like, don't go into 500K rounds anymore. They go into $3 million rounds. Well, okay, well, who do I get money from the small rounds? So it's like continuous churn. And then if you're a small fund, it takes a couple of funds before you start getting exits. So who are you going to raise from? So there's this always, and it's getting worse, this gap of not enough people doing small checks for small rounds. So pre-seed has a lot of constant churn to it. There are less regular angels than there used to be. You know, it used to be that there was like 20, 25 people in New York you could routinely count on for writing 3 checks a year of 50K. And those people very quickly professionalize now. You know, like, oh, I wrote a few checks, now I've got a syndicate, and, you know, 3 years later, now I'm raising my $25 million fund, and then they're, you know, down that rabbit hole of like, oh, now now I only do $3 million rounds. Like, I remember the first round of GroupMe was 865K. I think it was at a 2.8 pre. Josh Kushner wrote a 25K check. I don't even think he's writing $25 million checks anymore. That's probably too small for him right now, right? Dave Tisch wrote a 25K check. He's still doing like pre-seed stuff, but like a lot of the people that wrote small checks for that deal, like, are doing it anymore. And so that's always going to be a problem. And I really wish there was an institution that would solve that would just say, listen, like, we only want to fund micro funds, and we'll fund them for 3-4 funds at a time so that they're just always present in the ecosystem. I don't know if it's like the local pension funds that should be doing that or something, but you want to have a thriving sort of first check ecosystem.
Oh, sorry. But circling back on what you said about, you know, not having too much data, right, especially early on, are there 1 or 2 items in particular when you're talking with founding teams where it kind of drives you to a quicker, yes, I want to invest, or no, you know, it's really not for me?
Yeah, I would say that like 80% of my due diligence is done before I even take the meeting. Like, I usually take the meeting, and this is just my process, I can't speak to other people, but like, I keep a really high bar for first meetings. So I probably see like 2,000 things in a year, but I probably only took 150 first-time pitch meetings. So there's a big cut. And this is probably from experience. I've been doing this for a while. I have a sense of like, yeah, I could see myself doing this deal or not. But I would go into the meeting saying, okay, this is what I think the hard part is. This is the easy pitfall, right? Like, so maybe there'd just be this deal where like, this would be good if they could solve the chicken and egg problem. So I really want to hear them have a clever response to the chicken and egg problem, right? And if I go in and I drill down on that, I'm like, listen, I really need to know how you're gonna get around the chicken and egg problem. And if they say something like, oh, well, you know, we're in tight with this like one influencer that we've given free equity to on our cap table. I was like, no. Like, how many times has an influencer just like totally let you down, or they, you know, they're all ready for the big post, right? And the like the product is like not even in the shot or whatever. Like, they're just a pain in the ass to deal with, right? And if that's the whole thing your company was counting on, not a good answer, right? So there's usually something where I go in and like there's a couple of hard things about this deal that if you had a great answer to, I'm likely to be in, and if you had a mediocre or not good answer to, like, we're going to move on. I usually know what those are beforehand. And then, yeah, so there have definitely been things where, you know, in the first 10 minutes, I'm like, oh great, you totally nailed the problem. You know, they'll come in with a pitch that says, listen, a bunch of people have tried this and no one's been able to get over this thing. And here's our, I was like, wow, yeah, that was literally going to be my question. You know that other people have had problems here, and you knew that that was the hard part, and you knew that that was the way to get over it, and we're on the same page, right? Those things tend to stand out right away. The last deal that I gave a term sheet to, I was in a spot where I had given out a term sheet. The deal hadn't closed, so I was still meeting with companies, and I was like, I don't know, this deal might not close. And it didn't wind up closing. The founder decided that, you know, it wasn't a good fit. We kind of mutually, the founder said it, and I was like, yeah, this probably isn't a good fit, and we decided to move on. And so I had said 2 other deals of like, they're not backup deals, that's sort of not fair, but like 2 other deals that if I still had a fund, I probably would have done both. So they were at that bar, and I was like, okay, I'm going to take one more meeting for each company. And one company, it was just really early in its product development life cycle. And I asked a few questions about like what things are going to be important in the product development, and how can I get conviction that you are going to build the right stuff. And I sort of got an answer that I felt a little bit was like, we're going to test a bunch of things out, which like is an okay answer. I mean, I like some testing rather than none, but my own personal conviction was like, I really wanted them to say, I think the end user needs X to feel like this is a good product. We're building that. Now, it could be wrong, but I wanted them to have like an initial direction, and I felt like this is going to take a little more time, right? These folks are a little more in learning mode for this stage of the life cycle, and actually, given the economic environment, I'm not confident that there's going to be another easy check right after this. So I kind of need to find somebody who like kind of knows a little bit more about what's next. And the other company was a company that I had given feedback to about the financial model. And when we came back to that next meeting, they were like, they looked into all the things that I had said. And they're like, hey, so we did, you know, we talked about A, B, and C, and we did A, B, and C, and they turned it around. They're like, now look at our model, whatever. And oh, by the way, we closed some more people. It's like, oh, these guys are moving. Like they listen, they're coachable, you know, whatever. And I was like, oh, I have a very good feeling about what it would be like to work with this company. And again, especially in the environment, like they're closing revenue. They're not waiting for the end of this round. And that was just very comforting. So I do think there's something to like, if I don't fund this, this is still going to be successful. And I think there's that feeling, which maybe in hindsight, there were some things where they needed me to be successful, and I was excited to be that helping hand, but maybe I should have screened a little bit more for like, these people are going to be successful without me. People get into relationships like that too sometimes. They're just like, oh, it's okay, we need each other. And it's like, you should probably maybe pick somebody who doesn't need you as much as they do. So, that's not personal experience. Any other, just in terms of time?
And by the way, I loved the way you recounted your moments of serendipity when you bumped into Brian and the kid who pulled you up. You know, you got investments from his brother and sister-in-law. I really like that. But my question, I guess, is fitting to the end, is what next? What are you up to?
So a few things. So there's stuff that I know that I'm going to do, and then there's stuff that I'm like, I'm opening up half my plate for some newer thing that I don't know will wind up being a thing, but at least I'm going to try it. And then there's other stuff that is like much more like I'm working on. That didn't make any sense, but so my initial priority is a lot of people have asked me about stuff like this and community things and things that we've done as a fund that the fund is no longer going to be in a position to like subsidize me to do anymore. I'm actively working on moving that stuff into an umbrella that will be self-sustaining. And so sort of stay tuned. Like we're trying to create a community entity that will be sponsored and kind of run on its own and still do the office hours events and, you know, the VC panels and all of that kind of stuff. I would like to extricate myself from it as much as possible, but I still like hosting panels and whatever. And so I'll jump in every now and then. So that's going to be a lot of work, and so we're in the process of doing that now, so that hopefully at some point it can be 5 to 10% of my time and not half my time. I do still feel like I have some things to be helpful with companies, but I don't want to invest or advise. So I think one of my favorite things to do is like tear apart decks. I love tearing apart decks. You come in and be like, here's my deck. I'm like, this is terrible. I'm going to take this whole thing apart. And if you talk to one of my portfolio founders, like a lot of them have gone through either the round that I'm in or the next round or whatever. And what I really like about that is that I feel like I can jump in and be helpful for a finite amount of time, and then good luck. And then you're out raising it, and I'm not making capital introductions. I don't have to live with whether your fundraise was successful or not. And so I probably will, just from a consulting basis, try and do like let's sit down for X number of hours and we'll just collaborate and we'll output a story that makes sense, you know, and I'll do a couple of those a month. I do want to do a little bit of coaching. I had a really, really good experience coaching, like being coached. When I was at Union Square Ventures, Fred Wilson's former partner at Flatiron back in the day was Jerry Colonna. And Jerry Colonna is like the coach guy. He started Reboot, which is a great coaching organization. And I had the opportunity to do some executive coaching sessions with Jerry, like 5 or 6 sessions. And it was really great because he had been a VC. He'd been a VC, he's from New York, and he knows all the players. So it was like starting out in 15, because he knew, I didn't have to explain to him what my job was. Like he knew it, he got it. And he was really, really good at asking questions that I might not have asked myself. And I found it to be a very valuable experience. So I think probably the 2 types of people that I'm going to focus on coaching on, early career investors or people who want to be, that are working somewhere in the ecosystem and, you know, have line of sight to possibly being in venture. I think it'd be helpful there. And also people who have like a serious skill that can be helpful to the startup community, but like nobody knows about it. So people who just like have not been very public, who are now realizing that like as they get into LinkedIn and it becomes a content factory, they're just like, oh, I actually know more than a lot of these other people, but I have not taken the time to put myself out there, and maybe I'm not comfortable with that. I have a friend now that I'm helping who she runs a customer acquisition agency, and she's never done any of this stuff, and she got interviewed at a conference. and the interview, which was put on YouTube, is driving like more business than anything else. She's like, oh, maybe I should do more of this, and she hasn't thought about narrative or anything like that. So I'm going to help a few people with that. So that's like my how I'll stay in the tech community. And the other half of my time, which is like completely different, is I have been involved in the kayaking community in New York for a long time, and I started the kayaking program in Brooklyn Bridge Park in 2010, and there's no accelerator for community boathouses. So over time, being involved in this for a long time, we've gotten a lot of inbound from I do events for a public park in Philly, and we're on the waterfront, and we would love to have a program like this. We have all the questions, like, where do you get the boats from? How do you train people? How do you make sure people don't drown? Do you pay people? Everything. And what's really fascinating about these programs is that the boating is an excuse, actually. It's not about the boating. It's about the fact that you can do recidivism programs, and you can do adaptive paddling for vets with disabilities. You can do youth employment. You can do Brooklyn Boat Works does STEM programs with boating in schools. You can drive a truck through the types of impact you can make through this fun, urban boating programs. And so I think it'd be really interesting to start some kind of a national organization to help people get started and grow and be a resource to each other. And I think it'd be fun to pick some ridiculous goal, let's start 100 new community boathouses or something like that. I don't know if that's a realistic number. I've not even started. But my hope is that through the coaching and all of that sort of stuff, I'll be able to keep the lights on and pay a couple of bills, and then maybe start this organization. But I do think there's something to be said for, if you aim for bigger scale, sometimes it's easier to raise money. So if I just try to do boating in New York, REI is not going to care. But if I go to REI and I'm like, hey, let's start 100 new community boathouses, that's at least at the level where they can start to care about that sort of stuff. So that's going to be a project that I will start as soon as my daughter goes into a TOOS program, and in September my time frees up. So we'll see how that goes. Maybe that's a good place to stop. So, thanks everybody for coming. Thanks everybody who tuned in online. And thank you for kicking this off with a bunch of really good questions. I appreciate it.
Happy to help.
Thank you.